Arjun Paliwell, welcome to the podcast, mate.
Mate, it's good to be on.
It's always a pleasure to catch up and have a bit of a chat. How things been on your end?
Very, very well this way. Been as good busy as we possibly could be, and look, lots happening in the market, and so I think it's challenging but fun times.
Yeah, no, it's definitely a crazy market at the moment, but it is fun. It's good to get on top of. But thanks for coming on. I guess really today it's more about sort of your personal philosophies on building out portfolios over the long term, and some of those things and mistakes that you've made along the journey that others might be get some use out of. But I guess on that philosophy piece, what do you feel would be your personal outlook on building out a portfolio over the long term?
I think the biggest thing is realizing that it isn't short term, right? And the long term word that you say is so important, because what sometimes the media, storytelling, and the way property finance is built from your interest only, principal and interest, and so forth, it can lead to make people believe that under the traditional route of buying property and holding it, you can immediately get passive incomes in 2 to 5 years and quit the job and so forth. You can, under certain terms, put it interest only, high yielding properties and so forth. But really, it is a long-term journey if you want sustainable streams of passive income, more so 15 to 25 years. And so I feel like that's the first thing with an investing mindset. If you can have that philosophy to go, hey, firstly, if I am thinking of the long term, that's one. But then second, what that does for you once you acknowledge it is you have this weight come off your shoulders, because you're not trying to compare with each other. You're not trying to think of how do I make rush decisions or slightly riskier decisions outside of my risk appetite, that if you make, even though they could have risks that are fairly normal, you'll sweat, stress, and maybe even cull the decision and let go of it early. So I feel like, firstly, my biggest philosophy on investing and building a portfolio is to acknowledge the long-term nature of it.
Yeah, I think that's so critically important, especially when you consider the compound effect and how as you said, that it's really a finance game, and it's not until you take that long-term view and realize, I've only got a limited borrowing capacity and this is what we need to do. You need to make sure that those purchases are correct over the long run. If you could go back to young CBA Arjun Paliwell and go back in time and sort of have a chat to yourself, what would you say to yourself about building out your portfolio?
Yeah, good question. If I was to go back to the younger self, I would say that I wouldn't completely leave all the decision making in the hands of others. I made the right decision to support myself with professionals, which is great in the earlier phase of a portfolio, but I wasn't as involved as I should have been, which is the learning aspect of it. And so some decisions in the portfolio were phenomenal and they performed really well, but some not so much, which I went on to sell a few years earlier than most would typically want to sell. So if I went back, I'd say, yes, you don't have to be fully involved when working with professionals, but you have to be involved to an extent that makes you feel comfortable with the decision and never rethink it, right? And so that's kind of where I decided that, if I could go back now, I would be a little bit more involved in the investing decisions, to just have more learning, challenge respectfully, and then take that time to think about the why and the what of what's happening. That would be the biggest thing. And so, you know, that type of involvement just gets you more interested as well earlier on, rather than me realizing it, halfway through the journey that, hey, this is really cool, I like it, and I want to get into it. If I'd done that from the start, I feel like the earliest decisions would have been slightly better.
Yeah, and you and I have had plenty of discussions around your portfolio and some of the moves that you've even done fairly recently to chop and change those things. And I think you nailed it on the head there. As learn from your mistakes, and I think what you said about taking action quicker than many others would is actually a good thing, because you're addressing the problem, or not necessarily problem, but you're addressing those mistakes and getting on top of them early. And the next question really is, what would you change about your portfolio if you could? And I think you've already made some of those changes, but would you mind maybe just highlighting what some of them were?
Yeah. So I looking at all the decisions made in the portfolio, there were a few things that went really well and some that didn't go well. So what really went well is the aggression in the acquisition phase. You and I have talked about portfolio planning, and really the greatest passive incomes occur from those that can do two things. One is have the shortest period of acquisitions happen, and number two is have the longest period of holds. So I know that's like, it oversimplifies property investing to an extent, but it's true. Like, whoever can acquire the most in the shortest period of time and then go on to hold it the longest likely comes out better. So I feel my tight and sharp acquisition sort of period over like 6 years was a really good decision. The other good decisions were kind of spreading them across states, getting into various entry points of market cycles. And that's come out to be some of the great recent purchases and purchases of before. Other good decisions are buying around when you're ready to buy rather than buying when you feel the market's right. Because what I've come to learn is that every given time of this year, or every year, there is a place somewhere that is likely to have great prospects for the coming years. It's just about discovering it. And so in between all those good decisions were decisions that could have been better. And what I've come to learn is that, having a real understanding of demand and supply, and that can make a crucial difference. Now, it's easy to say demand, easy to say supply, think of population growth, but my understanding of all of this has been getting better and better each year as it's gone by. But when I first started property investing, it wasn't as great as it could have been. And I made a decision where I was overly excited by the prospect of numbers. And by numbers, I don't mean trend analysis, pressure analysis. I just mean how expensive or cheap something is, how much it rents for, or how little it gets for rent, what a vacancy rate is, and those simple things. And so then you get lost by affordability, yield, and vacancy. Now, none of those numbers suggest capital growth. And so that's where the earlier phases of the portfolio were driven by thoughts of what I thought demand and supply was, guided by and working with professionals, but they weren't. And so I ended up purchasing a newer build, dual occupancy, where it looked affordable, the yield was fantastic, a corporate professional, the tax breaks looked amazing. So all those things at the time of purchase ticked boxes. But then I came to learn about the power of supply data, and how much building approvals were happening, how much like-for-like stock, similar land, dual occupancies as well, all being sold to investors around me. So there wasn't ever any price pressure. Every investor wanted the best deal. Every investor wanted the best rental yield. And then also every investor happened to start being listed online for rent at the same time. And so this created a huge amount of vacancy. Rent started to reduce. Purchase prices went nowhere. After a quick blip on the way up, they went back down as people kept getting offered amazing deals to build these new homes. And so this is one thing where I learned asset types matter, location matters, new versus old matters. And that's kind of where I learned that piece there. The second decision that didn't go so well was a townhouse, both in the far western suburbs of Brisbane. Same thing. Asset type matters. It was a townhouse full of like-by-likes, full of assets that weren't really having any high pressure, supply risk, more building approvals, more townhouses, and what you feel is cheap, and you think from another mindset of, hey, that's cheap, that can keep going up forever. Like, it's not the case. So that's when I went on this journey of, I guess, trying to use these mistakes and figure out what data makes property tick in the positive ways. And I think those mistakes were blessings in a way, because I've now taken action and gotten rid of them. So rather than try and hold on forever thinking that this will be better, which it could be, I would rather just make the immediate decisions better today, because of coming back to that portfolio strategy you and I talk about. Whoever can get the best assets in the soonest and then hold it for the longest. Every calculator we end up running simulation on ends up being better when you do that. So that's kind of what I came back to: make better decisions now, use my learnings, use what I've taken away, and go from there.
Yeah, and it's funny you walk us through that story, because a lot of people talk about that sort of light bulb moment for property, or catching the property bug, or however you want to sort of term and phrase it. And then they start to go on this sort of wealth creation journey through property and building out their portfolio. And then whether they do get into the data or don't get into the data, it might not be the data. It might be, on the ground research and really understanding markets and how they perform and everything else like that. But the snowball effect starts to come into play when you get into that space. You start to learn more and more and understand different metrics and all the supply drivers and everything else you were just mentioning just there. At what point did it dawn on you that you wanted to start to transition this wealth creation journey through property into an actual career? And how did you find, or when did you think that would be the right move to do so? Did you feel like it was a passion project that turned into a career, or is it something that you knew you wanted to do from day one?
Yeah, so it definitely was passion project that turned into a career. Progression within my corporate role in the banks was phenomenal. Income growth was phenomenal. My wife was in the same, working industry as well. So there was nothing like shouting at me to say you have to leave, right? But a combination of a few things where I wasn't quite sure, from not so much from a corporate sense, but the potential of a business and what that could do for me. I always thought of that, having my father in business, and also just realizing that there's this new world out there. I definitely wanted to be in it one day, not property investing, but just business in general, or not property buying. And that combined with a moment in the career where things were getting quite predictable with the career. And so predictability, even in good moments and good growth, can actually be, quite make the mind feel like everything's quite stale. And this is where you don't really sound like ungrateful for the corporate position or scenarios I was in, but you do start to feel that mentally, you start to switch off or relax a fair bit. And I just didn't want to go through that period of life where you just know where you're going to be at 30, know where you're going to be at 35, know where you're going to be at 40, and then it just becomes the regular stuff. And so this is where that thinking combined with the realization of what the portfolio had done at that point, based on interest-only numbers and passive incomes that were coming from it, based on having this support from my partner as well, that allowed me to leave work without thinking too hard. Because what I've come to learn, and I share this a lot with others, when it comes to friends and family and just any decision making, people are built differently in terms of their decision making and how they get to it. And for me, my motivation on decision making to go and do something is, what's the worst it could be? So I've lived my life in that way, where if you're constantly analyzing all the steps ahead of, what it could be, the scenarios, what if this goes wrong, what if that goes right, and you're comfortable with the what's the worst it could be, that allowed me to take that move and go, hey, what's the worst it could be? I come back to a job, double six figures. I come back to a corporate company where I haven't burnt any bridges. I come back to an already pretty healthy portfolio in case it doesn't work out. I come back to it and I've got a loving, family, and hope they still love me if I come back to it. And basically, I also come back to it ticking a whole bunch of things on my bucket list along the way. So that's kind of where I felt that allowed me to think and start to quit. And that's where I quit. I was then thinking about what I wanted to do, and it was all those combinations of how much I enjoyed the numbers, the property. Went back to my banking days and realized how much I enjoyed connecting with people, supporting them, helping them think differently. All of that put together made me go, hey, you know what? This is what I want to do. And that's where I'm thinking of all those lunchtime chats with mates are like, hey, how did you do this? I'm thinking of this place and that place. And it just felt natural. That's where property buying led to be a career.
Yeah, that's phenomenal. And I think you touched on one of the biggest things that I love about you is that decision-making process of yeah, like let's just give it a go. This is the worst thing that can happen. If I'm comfortable with that, then, let's make the decision. Let's give it a crack, and you stick to it. You give it a good shot, a good 6, 12 months or whatever it might be. But if you fundamentally know that decision needs to be changed, then you're not scared to change it either. And I think that's what's driven your investor kit to be what it is today. It's such a successful business, and continues to grow exponentially. So you're doing an incredible job, mate. And the other thing that I love about you the most is that you do look after your clients, and you've always got their interest at heart. So I think it really shows sort of where you've come, that journey that you've come through working with other professionals who haven't always, got the best deals for you. And now you want to make sure that your clients are getting the best deals, which I absolutely love. Mate, there's 1,001 different property one-liners out there, and everyone's got their own sort of 2 cents that they want to chuck in. But if there was one thing that you could highlight as a property one-liner, what would it be?
Oh, you're getting me here, but property one-liner. Okay, here we go. So if there ain't no pressure, there ain't no growth.
I like it. Delving into some the 101 economics there, mate. We supply and demand. So I love it.
Yeah, I mean, I think me and you have talked about like dark growth data and analysis. And when I think of, the areas where people are buying a lot of property, or the areas where it's too easy to buy property, or people are saying this is going to be a growth location and they can just buy so much, I tend to find you don't know that it's going to be a growth location. One thing I do know is that market pressure means everyone wants what I want. And then when I miss out, someone's paid more. I adjust and look at it to realize that I need to pay more the next time around. That's what everyone's chasing, capital growth. And so if there's anything that's allowed me to make the moves I made today, the moves I'm making in recent times of the portfolio, it's the market pressure that we saw in my assets in Bendigo. It's the market pressure I saw in the asset in Sydney. It's the market pressure that I saw in my asset in Tassie. And that's definitely what's leading to capital growth in better times for the portfolio. So yeah, for everyone out there, if there ain't no pressure, if you're winning deals too easy, there ain't no growth.
I love it, mate. It's a killer one-liner. Well, thanks. I always love having a chat with you, mate. Thanks for coming on and having a bit of a chat, and giving us plenty of insights to sort of think about building out a portfolio. And hopefully we can have a chat again soon.
Yeah, awesome. No, thanks for having me, mate. If I can leave the audience with one last thing, the thing I'd share as well is that when building out a portfolio, it's easy to just remember the buying. It's important to remember the consolidation. And again, I mention us too, Jordan, because you and I get to chat a lot about portfolio building outside of this. And when we think of consolidation, that's where people start having a smile on their face in those portfolio sessions when they go, oh, wow, I'll be on 50K, 100K, 200K. Well, guess what? It comes from money in your offset getting built up. It comes from P&I repayments after some holding time of the portfolio to see the debt come down. It comes from a closure of assets after you sell some, keep some. All depends on your income levels and how much you want to hold in terms of assets. But if I was to make anyone really rethink property investing, all great about where's the hotspot, where's the deal, where's the pressure. But I want you to think of 20 years later, where do you start consolidating and how? Because that's when you'll be able to have that time back with your family and really use property investing for what it's for, either creating a legacy or getting some sort of stream of income.
Yeah, and I'll be the first one to admit that, some of those exit strategies, or I wouldn't call them exit strategies, but consolidation strategies that you put into play and map out are pretty phenomenal. You definitely taught me a thing or two about that stage of the portfolio, and you bang on. It's the most critical point. It's all well and good to be aggressive in acquisition and building a portfolio in the now, but it really does come down to that consolidation point and making those really key decisions when it comes to consolidation around, do I go for a final really high cash flow dwelling, or do I sell some assets and pay off some debt on my existing portfolio? There's so many ways you can go about it, and I think you've really honed in on some specific things that should do based on an individual's risk profile. And the best ways to consolidate. But no, mate, you've done a phenomenal job on all the portfolio strategy conversations that we've had, and so it's an absolute honor to be a close friend of yours. And mate, I'm super excited to talk again soon.
Likewise with you, man. Thank you.